is Michelle Hale, Community Outreach Supervisor for Greater Nevada Credit Union. Thank you for joining us on this recorded presentation. We would like you to put yourselves on mute and take off your camera as well until the question and answer sections. Greater Nevada is finding a growing need for financial education from our community members. Each month, we will be showcasing a financial topic that we hope will help our community move forward together with financial wellness. If you're interested in learning more about our webinars, please check out our website at gncu.org and search for Greater Financial Wellness Hub. Today's presentation is on debt management. I would like to introduce your presenter, Christal Chapman. Christal is the branch manager of the New Vista branch, and she has been in the financial industry for 6 years. She's passionate about educating others on debt, budgeting, and credit. Christal has attended credit seminars through her financial career, and these topics are what make her excited about helping members. In Christal's personal life, she loves to be outdoors with her lab and going on hikes to the water so he can swim. Also, Christal has been weightlifting for 3 years now and is one of her favorite hobbies because she loves to see her strength grow by staying consistent in the gym. Welcome, Christal.
Hello, everyone. Welcome. Thank you. I'm excited for everyone to be a part of the debt management conversation, and please get your questions ready because I'm happy to answer them and go over everything with you. We're going to get started and just talk about debt management. Alrighty, so in this debt management workshop, we're just going to be talking about the common reasons why people find themselves in debt and the most common types of debt as well. We're going to describe the value of using debt management strategies, such as loan consolidation, budgeting, and debt management plans. And we also want to compare some various debt management solutions to help relieve maybe some stress in regards to debt in your family. Alrighty, so the reality of debt is that over 75% of Americans are in debt. And with that being said, it meaning that, essentially you owe one party money. The reason why it is so important to talk about it is because the amount of debt can affect your overall credit score and also essentially your health, and it can impact maybe how you're feeling with how much debt you're in and all that as well. So this slide is talking about and what the different generations and how much debt everyone is in these types of generations. So essentially Generation Z, that is going to be your 18 to 24 category. And then your millennials, that's your 25 to 34. Gen X, that's going to be your 35 to 49. And then baby boomer essentially is going to be 50 plus. All right, so debt can have a negative impact on people's health. This is something that we come across, especially in the financial industry, is that we see people take on this stress and this burden that comes with debt. This is the reason why I love talking about this stuff. I love having deep conversations with our members and talking to people so we can help relieve that stress and ultimately live a better quality of life. And that's the goal here, is that debt is not supposed to be something that's supposed to be a burden on you. We want to relieve that stress with people. So overall, 31% say that they worry about debt in general, and it does have effect on their relationships. So 21% say debt has caused tension within their partner, and that's definitely not something that we want to see with our members, and we want to be able to relieve that stress. Debt can make it really difficult to pay for emergencies. So whether that's an unexpected medical bill, and some of those can range between $1,000 to $2,000, and that's a report that came back from 2019. And those unexpected medical bills make it really difficult to pay for other obligations that we have in our life. One thing that I wish I could do is, I like having these conversations with people, but one thing I wish I could do is I wish I had this magic wand that I could just waive all concerns in regards to debt, because with education and getting ahead of this, that's essentially what I want to do. That is my magic wand, is providing that education for everyone so we can help relieve some of that stress. So overall, we want to plan for the future. So over 30% of millennials, they put off buying a home or putting money towards retirement because they are worried about paying off their bills or worried about the debt that they have. 45% of the adult households doesn't have retirement planning out. And a lot of us maybe have seen our grandparents live paycheck to paycheck because they're on Social Security and they didn't plan for retirement. And so that's one thing that I don't want to see is I don't want to see people have to live just solely dependent on Social Security. We want to be able to plan for the future. And that's the reason why we're having this conversation, to help relieve some of that stress. So signs of debt distress. This is something very commonly that we'll look for in the credit union industry and in the finance industry, is to see where are we seeing that stress. Maybe someone's not going to, a lot of times people aren't going to vocally tell us about it unless they're comfortable, but a lot of times we'll have to see it through things on their account. So maybe they discuss, they had to go get a payday loan because they needed to pay off some debt, which is something that we typically don't like to suggest. Because of the high interest rates and the lack of education that they don't give whenever you do go to those resources. They're just more, in my opinion, that they're more concerned about getting you the loan instead of providing the education to you. Paying off minimum payments on credit cards. So essentially the minimum payment is going to help pack down that balance. So that's where we see some of the distress is only making minimum payments instead of making larger payments to pack down on that balance. Paying over the limit on one or more lines of credit. So, or excuse me, not paying, being over the limit. So what that means is just maxing out your credit card over the, say you have $1,000 credit card limit and you went over that limit on that credit card. Delaying medical and dental visits because you're concerned about you're not going to be able to make the payments to them. And that just keeps building upon the stress with that as well. Just making sure, or unfortunately not being able to go to the doctor because you're concerned about all the other stress. And we want to be able to relieve that by getting ahead and providing that education. It's also using credit cards to pay towards living expenses, having overdraft protection to pay all your regular bills off of your savings account, using your savings to pay your bills. So all these things are just signs of distress. And like I mentioned earlier, we want to be able to hopefully relieve that from you. All right, so there are different types of debt in this, in essentially credit history. There's good and bad debt. Good debt is your mortgage and your student loans. Mortgage, in my opinion, the mortgage typically always increases over time, meaning your home value is going to increase over time. So the money that you're going to bring back when you sell it essentially is going to put more money in your pocket and you're paying yourself. And also with student loans, typically that comes with higher paying jobs.
Okay.
So the student loan will help with giving some more income and then also hopefully relieving some of that debt as well. So those are the good forms of debt. And then some of the bad forms of debt is buying brand new vehicles. And then also credit cards with high interest rates, just because there's going to be tons of interest that's getting packed on that credit card. So essentially we want to, if you're going to have a credit card, not carrying high balances on there and just essentially having lower balances on those credit cards. All right, we're just going to start off with, does anyone have any questions?
Hi, Crystal, and then hello, everybody. Thank you guys for joining us today. My name is Saray, and I'll be helping control the chat, and we more than welcome you guys. We have time to take questions today, and that's kind of the benefit of joining these live seminars. So we welcome you if you want to take yourselves off of mute during these question breaks or type them in chat. Don't be afraid. I will be that person to kind of jump in, pause, and interrupt Crystal to make sure our questions are taken care of. Crystal, it looks like we don't have any at the moment, so we'll continue, but I'll pause you if we have any come up.
Excellent. And one thing I want to mention that Saray put in the chat is that she looks at the way that mortgage and student loans are an investment more than debt. And that's absolutely true. It is an investment because essentially it's going to pay off in the long run. Perfect. So we're going to move on. All right. So this is where a lot of my passion comes from in debt management, is creating a budget. I am old school. I am a pen and paper type of person, and I do a budget 2 to 3 times a month, and I evaluated it, and every single paycheck that comes through between my spouse and I, we break everything down, and then we make payments towards the things that we have obligations to, and then put money for savings or towards wherever we're wanting to put the money and reallocate things. I believe that every single person should have a budget and should analyze a budget on a monthly basis. I'm not saying that you have to do it my way, by paper, but also I do recommend, having some form, whether that's going to be a digital way, whatever way that makes you happy, as long as you're sticking to that. With a budget, what we like to see is a 50-30-20 plan. And so always following the number one rule, and that's living within your means. So not exceeding those means, because that's where the distress ends up coming in. So essentially what the 50-30-20 is that 50% are the needs, meaning your rent or your mortgage or your utility bills, your car payment, your insurance. Those are all things that you need in order to live your life and be able to go to work or whatever the case is. Those are going to be your needs. Your wants are going to be the fun things that you want to do, and where you're wanting to, things that you want to enjoy, things that you're wanting to go spend money on. That's going to be your 30%, which is your wants. And then savings and recovery or debt recovery, that's 20% of your income. We want to pack towards that debt recovery and also paying yourself and your savings long term. And this overall, if this is followed, this is going to be potentially leave that stress as well. If you're just jumping in, not a big deal. We might just need to reallocate this, maybe put more towards the savings and debt recovery, and a little less towards the wants, and just reallocating the budget until we get things under control. And just so you guys know, this is something that I love doing with my members. This is something that makes me passionate. I love talking about a budget. And so if there's ever a situation that you're wanting to talk about and one-off, you're more than welcome to join us at the Vista branch or any of the other locations, and we can talk about budget as well. All right. All right, so savings and debt recovery. Consider using funds in the following order. So creating emergency funds. So when in our savings account, we like to see about 3 to 6 months of savings and 3 to 6 months worth of savings in order to live off your living expenses. So that should total up to the amount of money that you need in your living expenses for the 3 to 6 months. And we also want to maximize the 401k employer match. What that means is if your employer gives you 5%, making sure that you are inputting money, maximizing that out by putting your own 5% in there, because essentially you're just leaving money on the table. So if you're only putting 3% in there, but the employer gives you 5%, that means they're only going to match you at 3% and you're leaving that 2% on the table. So bumping that up to that 5% from you and having the employer also match you at that 5%, that's going to be the best way to maximize out your 401k. Also, one thing I want to go back just a little bit with creating that emergency fund, we want to build that savings up. And I think this is something that people just didn't realize, but I think COVID really kind of shined some light on why we need this, because we never know what's going to happen. And we want to hopefully relieve that stress. And especially when all these things were going on, hopefully that the money that you have in your savings account, if something did happen, you can relieve that stress by having that 3 to 6 months worth of living expenses in your savings account. So paying off high interest and high annual percentage rate debt. So if you have a credit card that has an extremely high interest rate, we want to pay off that debt by packing some more money towards that or paying more money towards principal. So if you have a high loan with your auto loan and your interest rate is maybe 10%, my best suggestion is something that I always recommend my members. If your payment is $350 normally, if you have the financial flexibility, putting that extra $50 towards the principal to pack down on that payment. Essentially, overall, you'll be paying less money in interest because you're paying the loan off earlier. Contributing 50%, not 50, 15% of your gross income to retirement. So paying yourself in the long run so you can live a life when you're able to retire, hopefully live it stress-free, enjoy that time, whatever you have planned for your retirement, hopefully live that time stress-free. And so contributing 15% of your gross income to retirement. Lastly, paying off lower interest rate debts. This is essentially done by just reducing that wants category that we were talking about earlier in your budget, and paying off those debts so you could essentially have more wants and be able to do whatever you would like to do with your budget. All right. So cutting expenses and adding income. The first step in freeing up some funds and your freeing up things in your debt recovery is cutting expenses. So reallocating your budget and looking at where you're spending your money. My favorite thing is unfortunately looking at that statement and seeing, where did I spend some money this last month? Where could I have not done it? Not necessarily to beat you down and say, oh, I shouldn't have done this, but more of just a realization like, oh, I was spending money. Maybe I went to Starbucks too many times, or whatever your vice is, maybe reeling it back a little bit to cut some of those expenses. So where we can cut expenses is eating out. So limiting it to one time per week, and that will cut out some expenses. Maybe if you're not using your cable bill, if you're not utilizing cable as much, maybe cutting your subscriptions to premium TV. I am a victim of this. I have Netflix, I have Hulu, now there's Peacock. There's all kinds of things. So maybe limiting, where am I actually viewing things on TV? Could I limit this? Maybe I don't need all these subscriptions. And so that's a good way of looking at your statement, because then we can analyze where everything is. And yes, Saray, yes, Disney Plus, that's another one where we all have subscriptions to, maybe limiting those, and that will definitely cut out some of the budget. Another thing is in your grocery bill, maybe not buying name brand things, maybe buying the store brand, and that can definitely cut some costs as well. So strategies for creating some income is selling things. I'm a big fan of Facebook Marketplace, is selling some stuff on there, reallocating some funds, and then also getting a second job as well, if that's something that you need to do in order to pay off some debt. Alrighty, so debt repayment strategies. So the two strategies that we have is the avalanche method and the snowball method. Both are effective. It's really whatever the person needs in order to stay motivated. So the avalanche method is paying off debts with a high interest rate. And the snowball method is paying off debts with the lowest balance. So the avalanche method is personally my favorite. This is something that I typically have done in my past, and this is what I recommend. It works for me, but it doesn't work for everyone. And what I mean by that is the avalanche method is that you're paying off those debts that have the highest balance with the highest interest rates. Whereas the snowball method is where you're paying off something with the lowest balance. Maybe the interest rate's not as high, but what the good thing about the snowball method, and that the reason why most people probably go this way, is that say you have $1,000 credit card, but the other ones are 5, 6, whatever the case is. Getting in that routine and feeling confident in the snowball method by making those payments to the smaller credit card, feeling really comfortable with that and within your budget. And then once you pay that smaller credit card off, that's a big celebration for you. And then you can move on to packing down that payment, maybe some extra towards the higher interest and higher balance credit cards. For me, and the reason why I prefer the avalanche is because we're paying more interest. And so that's the reason why I believe in packing down on the higher balances and the higher interest ones as well. But like I said, it's really whatever is going to keep you motivated and keep you engaged in that debt recovery, and hopefully alleviating some of that stress that comes with debt. So major credit cards, sometimes they range around 26, 28%, and if the balance is $3,000. Essentially, this example right here between the major credit card, store credit card, and personal loan is packing down maybe on the store credit card first. That's the snowball method. Paying that off first. Now you can use that payment that you've been making it and then add that onto the higher balances moving forward. If you want to go the avalanche method, that is essentially packing down on that major credit card and then putting the remainder towards the smaller ones. Like I said, it's whatever makes you happy, whatever is going to keep you engaged and towards your success with your finances. Alrighty, so some of the don'ts. So one of my most favorite things that I like to describe when it comes to credit is that it is a timeline. So history is a timeline, and we describe our timeline in things that have happened over history. So whether it's positive and negative. So with your timeline, the reason why one of the don'ts is don't close out your credit cards is because you have that timeline of history. So maybe you started your credit card back when you were 18 and you finally got a credit card. Well, closing out that credit card essentially deletes that timeline of history. So you making your payment on time, keeping great balances, having amazing utilization on your credit card, that timeline essentially gets deleted when that credit card gets closed. And that's the reason why the credit card or the credit score will essentially dip, because that timeline essentially gets erased. We also don't recommend borrowing against your retirement plan, because that, like I said, is going to be paying yourself in the future. And so we tend to want to steer away from borrowing from your retirement plan. Don't trust all debt settlement companies without doing your research first. Make sure that you're using the appropriate resources and doing enough research prior to just going toward the debt settlement companies, and getting enough information to make sure that this is the right decision for you and your family. And then also don't hide from creditors. Unfortunately, I have heard many people say, well, this isn't my debt. This isn't what I need to worry about. This isn't my problem. However, unfortunately, that's not the case, because it's going to essentially financially impact you. So if you hide from those creditors, that's going to make a major impact on you, and essentially you're going to be hurting yourself. So we don't want that stress to be impacting you later down the road when you're wanting to purchase something. And that's the reason why we recommend not hiding from them. Okay, so the do's. So just to piggyback back on when I said don't hide from the creditors, we need to negotiate with them. So negotiate with them and see if you can come up to a conclusion of what you can pay, so you can get this debt resolved. One very, very common one is medical debt. Very common, unfortunately, in the debt collection. So making sure that we're negotiating with them to see if there's any type of agreement that you can come up with, so you can alleviate some of that debt. Get credit counseling, go through exactly what you guys are doing right now, getting some education, putting that education to use. Already an amazing step that you want to take this on and go into this course. And so getting that credit counseling and getting education in regards to debt, so you know how to take the right steps to your financial success. My favorite thing is consolidating debt. So maybe you have some credit cards with some high interest and also some high balances. Consolidating your debt into one loan, where overall you'll be paying less interest, and you can pack down that balance and pay it off quicker. And then also if it comes to this, hire a debt settlement attorney so you can get some help. So always negotiate, always try to see what you can do, put yourself first, be your own advocate, and see what you can do to negotiate with the creditors. Many Americans are overwhelmed with debt. I have come in my history of working with members, over my 6 years, I've unfortunately come across where they're extremely overwhelmed. And that's why I sit down and I have that budget with them. We talk about credit, we have those hard conversations, and it takes being open and, talking about this stuff in order to see that financial debt and also that stress be alleviated. So finding someone that you trust, that you want to talk with, and know that, especially if you come to me, that's going to be a no judgment zone. I'm not going to be judging you for what you've done. However, I want to make sure that I can alleviate that stress. And so that's what the goal is. And about 35% of adults with credit history have debt and collections owing an average about $5,000. So like I said, getting in with the collectors and seeing if there's a way you can negotiate that, so that credit history cannot be damaged. In 2019, there were more than 774,000 bankruptcy filings as well. All right, debt collections. So when debt payments are past due, your account is transferred to collections. If you maybe ever heard this, say you have a payment that's due with Renown because you went to go to their facility, then it eventually just goes towards the collections, and that can stay on your credit report for 7 years. So that is emotionally draining. That takes a toll on you, wondering, oh my gosh, how am I supposed to get ahead of this whenever this has been on my credit this is going to stay on my credit for 7 years. And this is the reason why we want to get ahead of it and start having these conversations. So hopefully we can not have this happen. If this has happened to you, no worries. You can always rebuild that history. It's going to be okay. That timeline that I talked about, that's where that timeline, you see that little red tick in the timeline, where it's going to stay on there for 7 years. If you had 1 or 2, of course, it's going to impact you a little bit, but please don't get discouraged, because there's always a way to keep rebuilding that history, and it eventually will fall off. Collectors may sue you, which can lead to wage garnishment, liens on your property, and foreclosures or repossession. So that's the reason why we don't want to hide from the creditors. We want to get ahead of it and negotiate, so you're not running into situations like this. And when debt payments are past due, your account is transferred to collections. So talk to an attorney if you're not sure that the debt is yours, or if you believe collectors are violating the law. Know your rights under the Fair Debt Collection Practices Act, and then also communicate in writing. So the reason why I want to communicate in writing is that if you said, oh, I had a phone call with so-and-so and negotiated this, I think it's very important to make sure that communication is also in writing, because it protects you, and sometimes those phone calls are not recorded. So always put yourself first, make you a priority, and communicating writing so you can protect you, to make sure that no one says that you never communicated and hopefully you're not taken advantage of. So that's the reason why we want to communicate in writing. And again, with communicating writing, make sure that you save all your correspondences, to make sure that everything is documented, just in case you ever have to reflect back to it. Alrighty. So with filing bankruptcy, honestly, this is something that was new to me. I didn't know all the details in regards to all the bankruptcy until about a little over a month ago. I just learned about all this, all the details about it. I mean, I've heard about it. I just haven't had direct correspondence with learning about all the details about it. So with Chapter 7, it can take 3 to 6 months to discharge debt. Your income has to be below the state minimum. So if you don't meet the requirement, unfortunately, you don't qualify for Chapter 7. And that's where you would actually have to move to Chapter 13. So it may be an option for people that do not have a lot of liquidable assets or property, to pay off some of those creditors. So this may be an option if you don't have that and if you are below the state minimum. But if you're not, unfortunately, then we would probably have to, you would get counseling, but then they would let you know which one you would qualify for. Chapter 13. So income is used to make payments over 3 to 5 years. Must have a high enough income to pay off your debts. Maybe an option for people who generally earn a reliable source of income and can make a plan to pay off the debts within 3 to 5 years. So whenever you come to a decision on what you're wanting to do, Chapter 13, you will make those payments over 3 to 5 years, and there's certain qualifications in regards to that. And lastly is bankruptcy. This can remain on your credit report for 10 years. You may be forced to liquidate assets, and it may not discharge all your debt, meaning that your student loans that you have, since those are federal student loans, those are federal loans, so those are not discharged in that debt with bankruptcy. So that's the reason why it's really important to make sure you get in contact with someone that you can trust and someone that would be a professional in this aspect if you had to go down this route. And with situations like this, whenever I've created a budget, I'll be honest, I've had situations that I've had when I've created a budget with someone, and unfortunately, I couldn't do the budget because of the amount of debt that we were sitting with. And I just, unfortunately, I have to refer her to a resource. I cannot be involved in that. It's just, I don't have enough education. I'm not educated in this area. The majority of the time, we can look at a budget. We can see what we can do to help relieve that stress. All right. Do we have any questions?
Hi, Christal, not so far. We'll give it a few moments to see, and you can continue if you'd like, and I'll just interrupt if we have anybody come through.
Excellent. Thank you.
Yep.
All right. So Everfi, this is a really great resource in regards to building your financial knowledge. And so if you're ever wanting to grow some knowledge, they're small little videos. It's not something that's going to take a lot of your time because some of those can be honestly extremely draining. So we I like these because it is small, little videos, and it just gives you some great education. I think anyone would benefit from learning from these. So definitely please check them out. I know that Saray will also email these out to everyone to make sure that they are able to access this after the chat as well. So it's something that I recommend. Like I said, it's a great resource. All right, some additional resources. It just talks about some credit counseling that you can get and balancing your financial fitness. So these are all, like I said, really great resources to grow your education and be able, and they're all free. They don't cost anything. This is something here that is completely free to you to build upon your knowledge. And like I said, anyone would benefit from this. It's a great resource and they really worth just taking a look at to see if there's anything that you benefit from.
Okay.
Perfect. So please don't be shy with your questions. If you want to put them in the chat, you're more than welcome to. I love being asked these questions because sometimes it's really good to, whatever your question is, a lot of times the other people will have the same question. So please don't be shy, and I'm here if you have any questions at all.
Hi, Crystal. I took a look and it looks like we have a couple coming in through email. And once again, you guys, you are more than welcome to come off of mute and ask yourself or ask your questions to Crystal directly. You can type them in the chat, or if you prefer more anonymous questions, you are more than welcome to email us. So before I get into those ones, we did have one pop up in chat, and it says, do you have any recommendations for how to deal with doctors who are charging you more than they actually should owe and are threatening to send you to collections? So medical debt question.
You know, honestly, I would get this is my recommendation. This is someone asked me this off the street. This is what I would recommend. And Saray, add into this if you need to. But my recommendation is honestly get in contact with your insurance company, making sure that you are advocating for yourself and using your insurance company as someone that can advocate for you, because also another thing is that your insurance company is responsible for paying for a portion of your bills. So we want to make sure that they are aware of what's going on. And also, I hope you've already done this, but also finding another doctor, because that is not someone that we want in our lives. That's obviously not putting your health first. So that's my recommendation, is definitely get your insurance company involved, tell them what's going on. And that would be the route that I would recommend doing.
Yeah, I definitely recommend that. That sounds like a discrepancy somewhere. And before that does get sent to collections, we want to get that stopped before. And medical debt's one of those great negotiable ones, right? As long as we're actively paying on it and have negotiated on what we can pay, we're not going to be sent to collections. And they're, in my experience, they've been more than willing to work with me. But I have had to, just like Crystal said, advocate and really get my insurance to advocate and get those numbers adjusted. So I can definitely relate to this one. I hope that helps out. And we have a couple more pop up. Can I just forget about my medical debt if it's older than 6 years, or that 7-year mark, right?
Ooh, that's a good question. You know, honestly, I'm not quite sure. I feel like I would get in contact with the collectors and see, maybe get some advice on that, or even with the credit bureaus, and maybe contact Experian, Equifax, or TransUnion to get some more clarification on that. Saray, do you have any weigh in on that? Because honestly, I feel like
actually, Tom Wheeler in our consumer sales did a debt management presentation. I was able to watch that. And of course, now please take this with a grain of salt. It always depends on your personal situation, but we do have that kind of 7-year mark. And if we're closely approaching that 7-year where some of that debt is going to drop off, depending on what type of debt, I hate to say this, but sometimes it is easy to let that debt drop off at that 6 or 7-year mark. Does it work with all kinds of debt? Not always. So again, it's kind of that personal situation that we would have to know. But advice from him, yeah, it could be almost more beneficial for you to have that drop off than it would be to pay it. Okay, another question. Can you talk a little bit about how we can use a balance transfer when paying off debt, like using one of those credit card offers that maybe offer that 0% for X amount of time.
Yeah, definitely. So I personally am a big fan of this. I have been involved with not only with my members, but also family and friends with helping with situations like this. I just honestly open the floor. I like to have conversations in depth about it because I think that it's so important. And honestly, it's more of like a taboo. Don't talk about it. Like you don't talk about it with your family, you don't talk about it with your friends, you just don't talk about finance. When really it's just so important because I can bounce ideas off each other. So one situation I had was I had a person in my life that was struggling with the amount of debt that they had. And what they did is they did a balance transfer. One of my favorite things is also Greater Nevada also has an amazing credit card that we can do a balance transfer with where you can have 18 months, 0% interest. So I'm a huge fan of that because anything that's longer than 12 months, that is a great opportunity to really get ahead of your debt if you have the flexibility to make those payments towards moving that money from one credit card that has a high interest rate and that you're going to charge interest onto another card. Sometimes, though, this doesn't work if you don't get approved for the amount that you need. So say your balance is $3,000, but your one that you got approved for 18 months is only $1,500. So that's the only downside is that you're not, if you didn't get approved for the amount that you needed. On the other side of it, you just get charged a balance transfer fee. Usually it's $5 is the term that they use, $5 or 3% of the balance. 3% of the balance is a lot lower than the interest rate that you're paying in 1 month. So go ahead and just add it on there and pay off that balance if you can. If you can't do the balance transfer, then I always recommend doing a debt consolidation loan. Debt consolidation loans is going to be a lot less interest still, even with the highest bearing. You typically, even with the ranges, say it's like between 9 and 20%, typically those ranges are still going to be lower than the interest rate that you're paying on your current credit card. A lot of the times, not saying it's always, but a lot of times it's going to help relieve that stress. So you're able to pack down that balance and do that debt consolidation loan. And there's typically no fees if you pay it off early. Just make sure you get some education and making sure you understand, like, if I pay this off early, I'm not going to be penalized for it. But that's
Yes.
a really great question.
I was just going to add on a little bit to that. These credit cards can really be a great offer if you can take advantage of that 0%. The only thing that I warn or advise you guys to look for is really look in those terms and conditions, because that 0% offer for X amount of months, sometimes credit card offers with that, if you don't pay that amount down in that X amount of months, they will charge you the interest on the whole balance and not the leftover balance, leading you to as if you just got a regular credit card. So be really careful with that. You don't want to end up in that same situation, and just really working through that budget, like Christal says, to make sure that it is a possibility for you to pay that amount down in the X amount of month time limit. And I think kind of leading into the next one, and we talked about debt consolidation loans, but other ways to consolidate debt. And I wanted to add on, Christal, one of the big ways that a lot of people don't think is we have those 0% offers on credit cards. We have debt consolidation loans, but taking out, if you're able to, if you own your car or home, you can potentially take out equity on your home or even a vehicle if you don't own a home. And those are some of my favorite ways, because then rather than being at that debt consolidation loan interest rate, which is typically like a personal loan rate, you're going to be now under a lower auto loan or mortgage rate. So that's one of my favorite ways to consolidate. Did you want to add on to that, Christal?
No, you know what, I'm so thankful that you mentioned that, because honestly, that is something that I've seen some really great success in. The conversations that I'm having is like, okay, do you own your home? That's usually the next question that we have. Okay, so now we know how much debt you have. Do you own your home? And if you do, okay, next thing is that maybe we need to get you in contact with our mortgage consultant so we can go into detail if that's cash out refinance is something that we can possibly do for you. Because that relieves the stress of paying all those debts off. That is amazing. That is something that we can absolutely use our home for value and definitely relieve that stress off. So if you own your home, not only is that good debt for you, but also that's going to hopefully release some of that stress if you do find yourself in some debt as well.
Yeah, and that actually, our next month's financial wellness seminars on refinancing a mortgage for those of you that do own your home and may be looking at refinancing with the great rates that are going right now. That may be a good opportunity to take out equity if you're able to. Okay, another question. I really liked this one. Let me take a look and pull up this. I think this is such a relevant question, especially when I ask it. I think you'll understand. When you're shopping around for an auto loan, how do you do it without hurting your credit so much? I think we hear quite a few stories, Christal, in the branch of good and bad ways to shop for a vehicle because they can affect your credit differently.
To be quite honest, there's two things you can do. So one being you choose your credit union and you just choose that person, or maybe you get a rate range and you get an understanding of where your credit is, and then you choose that credit union and that's the one you're going to go for. To be quite honest, my aspect of that's a great way. My way of doing it is I go to if I'm not doing private party, obviously private party is different, but I go to the actual place that I'm buying the loan. So if I'm going to Ford, Subaru, Toyota, Honda, whatever the case is, I go to them and I let them do the financing for me. I do the negotiating, and that's my way of doing it. That is the best way. I found the most success for me. And I have found the best options that way. Honestly, like personal example is that I've been working really hard on building my credit. And I went to go buy a new car and I did not go shopping. I showed up to the place, they ran my credit, and I qualified for 1.9. And I guarantee you, if I did not go to the dealership and do the credit union, I guarantee you I would have not gotten that 1.9 if I shopped around. So
yeah, that's
it was a way that they were able to get that for me. And I love loyalty. Please go to the places that you feel very confident with. I love that if you want to come to me, but ultimately we have to do what's best for ourselves and our financial success. And if I was loyal to my bank, even though I love my bank, if I was loyal to them, I probably wouldn't have gotten that 1.9. So you have to do what's best for you. And that's my suggestion. I will always suggest that. I will advocate making sure that you always do what's best for yourself and you finding the best thing for you.
Absolutely. I love that option of shopping around. And the only, again, the advice I want to give is when you are shopping around for a vehicle, just like Christal said, there's a couple ways to do it. One way to do it is to go to your bank or credit union, wherever your financial institution is, and get a pre-approval letter. Find out how much you're approved for, and that once we run your credit, find out how much you're approved for. That's good for 30 days, and you can go shop anywhere, whether it's private party or at a dealership, and you can already walk into that dealership, go, nope, my credit's been ran, here it goes. Your financial institution's going to get that paperwork ready for you and be done. In Christal's situation, that dealership had the car she wanted, she was going there, done. If you're shopping around, you want to be careful because each dealership that you go to, if they can run your credit each time, and that can count as multiple inquiries in a short period of time, which can possibly have a negative effect on your credit. So pre-approval, if you want to avoid that, or if that dealership private party has what you want, maybe look at doing financing through them, just like Christal said.
Yeah, and my biggest thing is always be intentional. So be intentional in every action you do, especially with finance, and making sure that you're being intentional, not impulsive. That's where, unfortunately, there's adverse actions to that. So always being intentional. Like if I know the vehicle that I want and I know what I want to do, make sure you're having legit thought that goes into it, making sure that you're being intentional in those actions, and then that's going to definitely lead to success.
Another great question that I think we overlook sometimes is, what is a term? What does term mean on a loan or consolidation loan, I assume, and what terms should we look for, or what are best? And I can kind of, if you want, I can kind of tune into that if you would like, Christal.
Yeah, so terms essentially are going to be dependent on what's in your budget. That's number one. So what is your budget? Also, it's very important to look at. So if you need a 5-year term, meaning 60 months, so if you need 5 years, so the length of the time that you're going to be making this payment, if you need 5 years, well, 4 years is going to be a little more expensive, meaning you're going to be spending more money a month to pay it down, but you're going to pay it off quicker. But sometimes your interest rate might vary a little bit depending on which term you go to. So that's the only thing, is making sure that if you're looking at what type of term you're looking at, for maybe an auto loan or debt consolidation, making sure that you're looking at, okay, what's going to be the interest rate difference if I go from a 48-month to a 60-month loan? What is going to be the interest rate difference for me? And also, what is my payment difference going to be for me? So if I have a $40 difference between, 12 months, am I able to afford that $40 difference versus spending less money in interest over the entirety of the loan? And it's kind of just playing a game, figuring out what's best for you and your family, figuring out what's best for your budget, what's going to work best for you. And if you need to go for that 60 months, but you have that flexibility to maybe make a little more money and put a little more money down on that payment towards the principal, and then the money that you decided on. So maybe you chose on a 60-month, because what if something happens in your life financially for a month and you're strapped on money? Now you have that flexibility, and maybe you don't have to pack as much money towards principal that month, and you can just focus on whatever you need to focus on that month, and then pick right back up if you need to do that. So that's my recommendation, is not binding yourself to something that's extremely high if you feel that that's not the best for you. It's really whatever is best for the person, and it's truly dependent on that. So being intentional, making sure that you're thinking things out and making sure that, is the 48-month going to be a good decision? Is the 60-month going to be a good decision? Maybe I need to go to 72 months if they allow me to do that, if that's going to be the best decision for me and my family. But I understand that the consequence may be that I might see an interest rate difference. And I personally have gone through that. Like, my husband and I bought a more expensive vehicle because we knew for the entirety of our life of owning this vehicle, it's going to be best for our family. However, we knew that the interest rate, because we went to 72 months, we knew the interest rate is going to be a little higher, but it was best for our family because it's an investment. So you kind of weigh it out and, be intentional with your decisions. And essentially you're going to see long-term intentional, and you're making good decisions and thinking it out with your education that you've been, that you've learned over the years. You're going to absolutely be successful.
I love that. And kind of relating to debt management, and we talked ways to do debt management, is do you refinance your auto loan to get that lower payment, to be able to put more money towards debt. Now, if you do that, the term is very important. Just like Christal said, if you do a longer term, that may be beneficial for you because you're lowering that monthly payment to be able to put towards debt. But just keep in mind, typically with a longer term, your interest rate may go higher. And if you do look at refinancing an auto loan or something like that, something to consider is, you may have to extend that term again. Maybe you had a 5-year loan and you've paid it for 3 years. You only have 2 years left, but you need to refinance it to lower it to pay off some debt. You're then maybe going back to a 5-year term. And some people don't realize that's what's happening. So really paying attention to that term or how long it is. All right, another question. Does the available credit on my credit card count towards my DTI, or is it just my balance? I love this one.
I'm pretty sure I think I know the answer to this. So sometimes it's so sticky when it comes to DTI. It just really depends. Because creditors can look at it and be like, oh, well, if I have a $7,000 credit card limit, but I only owe $1,000 on there, the potential for me to rack it up if I lose my job is also very high. I could potentially do that. So there's some risk behind it, but also whatever you're utilizing it is gonna do your DTI. So if you have a $7,000 balance on a $7,000 credit card, that's going to negatively impact you. So in my opinion, it's dependent on the balance that you owe on the credit card. However, when it comes to approving you for future credit cards, they're going to look at what you have available on all the other ones, and it might determine whether or not they approve you or not. So that typically, that's kind of a 2-part answer. But yeah, that's essentially, it's, whatever you're utilizing on the card, whatever your balances are when you go get approval on things is typically what they're going to be looking at. Okay, they have a $1,000 balance on their credit card. They don't have any other balances on the rest of their credit cards. Their debt to income ratio is definitely a lot lower. They're showing financial responsibility.
Yeah. And then I love this last one. It kind of relates to one that we got through email. But how do I build my credit if I have debt, or if I have credit card debt, or I'm, how do you build your credit?
Okay. So there's gonna be a couple options. So we talked about debt consolidation loans, so consolidating that debt on a debt consolidation loan, or doing a balance transfer on a 0% interest credit card. So depending on the amount, we will move that money over to another credit card, or we can do a debt consolidation loan. That will increase your credit because your utilization of your credit cards are going to go down. So we don't want to utilize more than 30% of our credit card line. So say you have a line of $1,000, we don't want to utilize more than $300. That's 30%, because that's going to see that you're going to see the most increases in your credit when you're utilizing it appropriately. So then the other answer to that is say you owe $900 on your $1,000 credit card, get that balance down below 300, your credit score is going to go back up because your utilization is less. So it is a game. It is making sure you're educated on the game. And that is how you are successful. It's just growing that education, getting educated on what is appropriate and what the creditors look at, so you can build that credit. So essentially paying down that balance, finding some way to pay down balances, and that's going to see your credit grow. If you are working on building your credit and there's other situations, then we also have a secured credit card. So secured credit card is another option. But first off, before I recommend that, I would want to look at your budget. I'd want to see where we're going with it. How far off are we? Like, are we not that far off? Is there a way that maybe you think that you're doing worse than you are, but you really aren't? So let's look at that. Let's take a look at the budget. Let's see where the credit card is. Let's pack some money down on that balance. Let's get below that 30% utilization. If that's not going to work, then we might need to go the secured card route, but we want to take a look at the whole picture before we just, make a decision. That's what I mean by being intentional. Looking at things, looking at the big picture, narrowing things down, and being intentional in your decisions. And that's what I mean by that.
I love that. Yeah, there's tons of things that come into factoring our credit scores. But, I like to explain it to the students we teach. It's how trustworthy we are, right? So if we're paying down our balances, we have a payment history or a positive payment history, we're not letting things go into collections, we're lowering our DTI. As soon as you start working on paying off debt and it's that top of mind, you're going to start seeing that credit go up. As far as right now, these are all the questions we have. We do have a few moments, and you guys, we will absolutely stick around. But right now, I'll go ahead and hand it over to Michelle Hale to go ahead and do an exit and give us some other resources. So thank you guys so much. And Michelle, it is all yours.
Thank you.
Thank you, Christal and Saray. Thank you to those who are attending our Greater Financial Wellness Series. For those that would like more information from Christal, we will be sending out a follow-up email with the survey and Christal's contact information. If you're interested in learning more about these webinars, please check out our website at gncu.org and search for Greater Financial Wellness Hub. And thank you again, everybody. And if you have questions,